Today I wanted to share the 5 key steps that I took that you guys can take too, that took my investment portfolio from £400 in 2017 to a combined total value of £148,319 in 2024. I'm going to cover these steps in no particular order, and in my opinion all of these steps are just as important as the others because all of them combined allow me to get to the position that I'm in today. And missing out on just 1 or 2 of these steps would have hindered my ability to achieve this investment milestone. So be sure to stick around if you truly want to grow your wealth this year. So the way I like to do things on this channel is to be fully transparent. So here you can see the individual investment pots that I have and the value of each one of them. You can see the biggest value is in my pension, followed by individual stocks, then my investment property, an S&P 500 ETF, followed by a little bit of cryptocurrency too. Now, all of this didn't happen overnight. I've been acquiring these assets like I was Pokemon cards back in 2004 over the course of the past 6.5 years, where I've quite literally gone from 0 to where I am right now. So let me explain how I did it. This is a slightly more esoteric principle, but everybody has something called their own financial thermostat. It's that pounds and pence figure that you have in your bank account that gives you that sense of comfort and security. It's the equivalent to that 21 degrees room temperature, but in your finances. And what many people find is that no matter how much money they go on to earn, they'll always seem to have that same kind of figure or thereabouts sat in their bank account. Now for some people that's a negative figure, but for others it can be 3 figures, 4 figures, 5 figures, and for those super financially successful, perhaps even 6 figures and beyond. But according to statistics from Finder, 46% of Brits are in the 3-figure camp, operating with a financial thermostat of less than £1,000, which simply means there are a huge number of Brits that aren't in a financial position to be able to invest, or indeed materially increase their wealth either. Now when I heard of this concept, it was certainly something that resonated with me, and I knew that kind of figure for my own personal finances and my own personal situation. It was a figure that if I went a little bit above, I knew I had a bit of headroom to spend a little bit more money, and inevitably my bank account always ended up in and around that specific figure. But more importantly, it was a figure that was high enough that allowed me enough financial security in my own life to be able to use some surplus money to be able to start investing. It's as much as a mindset thing as it is a personal finance thing. You can of course save more money by tweaking and changing some of your financial habits, and you can certainly open your mind to new financial possibilities by studying the right people and learning the right principles. It's important to break down any limiting beliefs that you have about money in order to raise your level on the financial thermostat to a level that's perhaps a little bit uncomfortable right now to think about, but is perhaps a figure that's desirable for your future self. I'm probably paraphrasing here, but there was a quote that I once read that said something like, "You first become rich in mind before you become rich in self." Quick one guys, one book that I recommend that captures this kind of rich mindset that I've been speaking about is this book here called The Secrets of a Millionaire Mind, which I've actually got 2 of, which I want to give away to 2 of you guys watching this video. All you need to do is be subscribed to the channel and drop this emoji down in the comment section below, and I'll reach out to 2 of you guys and get these books sent over. Once your financial thermostat is raised, the next thing to focus on is your investment discipline. What I would certainly encourage here is that you follow something like the 70-20-10 rule, or perhaps a more aggressive version of this model. Principally, it stands for using 70% of your income for your basic needs like home, food, bills, and your car payments, 20% of your income for wants, which can be holidays, takeaways, and dining out, and then 10% of your income for financial goals, which includes saving and investing. Ideally, I'd like to say squeeze that 10% up to 20% and perhaps try and reduce some of your expenses elsewhere. But 10% should definitely be a minimum target to aim for. I literally started off my investment portfolio with £400, which was probably about 25% of my take-home pay at the time. And the rest of the £148,000 or so was simply built from consistent monthly actions compounding over time. This is the type of investment strategy called cost averaging. It's a practice of investing a fixed amount of money on a regular basis, regardless of the share price. And for me, as you guys see on this channel with my monthly portfolio updates, I invest into the market every single month without fail, regardless of what the stock market is doing. And doing this through thick and thin, whilst also acknowledging that the stock market performance changes year in and year out, will be what puts you on the front foot for a very prosperous future, thanks to something called compound interest. The S&P 500's average rate of return is about 7% per year adjusted for inflation. If you stick those numbers into a compound calculator and you invest £400 a month for 40 years, you're left with a total amount of £1,343,000 £513 come your retirement. The math works itself out. All you need to do is be disciplined enough for long enough in order to realize the rewards. Talking of being disciplined with your investments, staying the course is also just as important. And the longer your investment time horizon, the better. Because with time buys you comfort, which when you've got your hard-earned money fluctuating in value day by day, there's nothing more psychologically comfortable about having time on your side to allow any kind of market downturn to recover. My Trading 212 portfolio is a perfect example of when times are hard in the market, the best thing to do is nothing. Here you can see my Trading 212 investment portfolio. And back at the end of 2021, after the bull run, you'll be able to see I had an unrealized profit on this portfolio of £7,157. But after the tech wreck of 2022, you can see how those returns massively declined to the point where at the start of 2023, I was sat in unrealized losses of £5,786. That's the best part of £13,000 worth of investment portfolio value flushed down the toilet in the space of about 13 months. But by staying the course and staying disciplined with my investments and continue to cost average into the market every single month in order to capitalize from some of the discounted share prices that were on offer at the time, my investment portfolio over the past 12 months has massively recovered to the point where I'm now sitting on an unrealized profit and absolute account all-time highs of £10,230 for a rate of return of 31.9%. So in the space of 2 years, we lost about £13,000 worth in value and then regained another £15,000 worth in value, which is pretty insane. Investing certainly isn't for the weak-minded, but if you can remain stoic in your actions and your decision-making, well, history tells us that you'll always come out on top. If you don't believe me, then just take a look at the performance of the US stock market over the past 50 years. There is not a single 20-year period in time that you could have lost money. And that's even if you did empty your bank balance into the stock market at the height of the dot-com bubble, which also seems pretty insignificant now given today's current market value. Quick segue, this part of the video is sponsored by Trading 212, who wanted me to tell you guys about some new updates and features within the Trading 212 app. Firstly, they've got a pretty insane offer going on right now whereby if you open an account, you'll get 1% cash back on all of your ISA deposits for the 2024-2025 tax year. So say you invested £10,000 in the next tax year, Trading 212 would give you an extra £100 back in order for you to reinvest or withdraw whatever you want to do with it. And as an added bonus, they've given all of my subscribers one free share valued up to £100 when they open that account as well. All you need to do is click on this link down in the description below. Now, aside from all of the free money, there are a couple of additional features that I want to share with you guys. So first up, guys, when you open the app, if you click on the little home bar, you'll be able to see over on the left-hand side that there is a new icon, which is a news feed icon, which shows you all of the latest news for all of the different equities on the platform. And if, say, for example, we click into one of these equities like Google, you'll be able to see it gives you a full breakdown of all of the recent news that's been going on. Likewise, if you've got individual holdings that you want to find out a little bit more details on, like advanced micro devices, for example, you can see there is now a little news feature bar when you click into the equity itself, and you can view all to see what's going on with AMD stock. And finally, one of the most popular ETFs is an S&P 500 ETF, whereby there's now additional visibility on the BlackRock iShares one, which you can see if you just scroll down, it shows you the individual weighted holdings of all of the individual equities that go into that ETF itself. It gives you a much clearer breakdown on your exposure within that ETF and how that kind of is weighted within your own investment portfolio. So thanks again to Trading 212 for sponsoring this segment of the video. Now, I'm fully aware that most of my investment portfolio has certainly come from me being diligent with my personal finances and has certainly come from my 9-to-5 job, maximizing my employee pension contributions along with using some money to invest into the stock market too. But what has accelerated my financial position quicker than what I could have ever imagined was from adopting something which I'm going to coin as a hybrid income model. It's the model of obtaining a personal income and a business income both with the aim of funding investments, but in slightly different ways. As I've said, my personal income is built up of my pension and my stock portfolio, which I hold in a stocks and shares ISA account. But my business income, on the other hand, has allowed me to build my new property investment portfolio. The financial principles that I've adopted in my personal life are the same financial principles that I've adopted in my business too. So now when I get paid into my business account from YouTube ad revenue or sponsorships or affiliate income, I send that money over to an investment business that goes on to buy my properties. It's the flywheel effect that works in such a powerful way, where your income turns into profit and your profit turns into investments. Now, if you can have two flywheels, one in your personal life and one in your business, in my opinion, you have one of the most powerful income models here on planet Earth. It's a low risk, high reward model, and not only do you get the security from keeping your normal 9 to 5 job, which, let's be honest, most people prefer to do, you also get the abundance from being able to generate an income outside of that 9 to 5 as well. My fiance says it's like having an additional person working in the household, which I guess perfectly captures the old adage of getting your money working for you. Now, underpinning all of this is a strategy of diversification. I diversify my income and I diversify my investment. So I have no single point of failure in any area of my finances. If I get sacked tomorrow, I've got my business income to support me. Likewise, if the stock market falls off a cliff, then hopefully my property will at least hold its value. As I've shown, I have my money in many different investment pots, and there is an intentional reason and a strategy behind this. It's of course to mitigate risk so that that financial thermostat, which I spoke about at the start of the video, is maintained at the higher level that I've pushed it to keep me at that level of comfort that I've now acclimatized to. Now, you can diversify in your investments in many different ways. So now let me just touch on a couple of them, because asset allocation is only one way to diversify your investments. A couple of others include time diversification from spreading your investments, like I showed you in step 2. You can get geographical diversification from investing both domestically and internationally as well. You can get industry diversification from investing in tech, finance, or consumer staples, or indeed any of the other economic sectors. What I'm trying to get at here is you can certainly diversify in more ways than one, and choosing the appropriate amount of diversification is individual to everybody, their risk tolerance, and their investment objectives. So look, mindset, discipline, time, income, and diversification are the 5 core steps that allow me to achieve a 6-figure investment portfolio. And if you want to know why this is such an important milestone that will massively accelerate your wealth, then be sure to click on this video next to find out why. Be sure to enter that competition if you haven't done so already. And with that being said, I'll see you over in the next one.